a Tuesday here, Guy. We have CPI tomorrow morning. That would be Wednesday. You and I are going to detail a trade idea in which to play your view about higher yields. We're going to do that with defined risk in the options market. The S&P that we've been talking about here, Guy, it's been making this sort of flag formation. We had a lot of volatility in mid-December after that Fed meeting. The Fed was a bit hawkish, right? We went back. We made a brief new high, but since then, we're in a series of lower highs and lower lows. How do you expect the S&P to resolve itself? Because, a lot of people, and our friend Doug Cass is one of them, is saying that if you were in the camp that the S&P is broadening out because we've seen most of the fateful 8 basically unchanged or down in the year, he's like, it's not broadening out. You know what I mean? That sort of thing.
It has not been broadening out.
Yeah.
So I look at the trend line, that uptrend line from basically, if you go August 5th low, and you draw that uptrend line that we broke probably in December or so in a meaningful way to the downside, that line subsequently was intact, and we traded back up to it and failed. To me, that's problematic. And here we're going to do this right before your very eyes, and we're going to show you folks what I'm looking at. So since then, there you go. Look at that.
Yeah.
Keep
going. Keep going. There it is.
There you go. So since that point, we've made a series of lower lows and potentially lower highs. I look at that and say, you know what? That's not a particularly good. The fact that we traded back up to it and failed does not augur particularly well, in my opinion.
All right, so let's talk about, tomorrow Fed Chair Powell is actually taking questions on the Hill. We also have that CPI report that's going to come out at 8:30. Look at that guy. He just seems pretty confident right
Who's
there.
Who's the dude praying? I think he should be praying, by the way.
That's a floor broker there.
Yeah.
So we go back to that mid-December, that Fed meeting, hawkish, right? We had that Jan 31 Fed meeting. So here we are a couple weeks later or so. What are the sorts of things in your mind that could spook the market right here? Because, you could make an argument that the 10-year has come in because of growth fears, that sort of thing. We've seen a downtick as far as some of the employment numbers and the like. We're seeing a downtick in some consumer confidence, business confidence, and that sort of thing. Fed Chair Powell in September, when they cut 50 basis point, they said they were here to support the employment picture here. What do you think changes? What do you think? And if he were to be more dovish, Guy, would that be good for equities right now?
I don't know what's to be dovish about. I mean, First of all, they have no control of the employment. He can say whatever he wants. I understand the mandate. I mean, the Fed does not control the employment picture, number one. Number two, if in fact they think they're controlling it, it's actually sort of trending their way because the unemployment rate has actually been going lower. So there's no reason to be dovish through that lens. And quite frankly, there's no reason to be dovish through any lens that you look at. I mean, I don't understand the want or the need to rush to cut rates again. And I think he's probably going to be sort of steadfast about that. So my sense is he is not going to say what the market wants to hear. But forget about the market. He's not going to say what the president wants to hear.
Yeah. And again, I wonder, though, if some of these tweets and some of this stuff, it just, they're flooding the zone in every which way, as far as, news and tape bombs and threats and, policy changes and the like here. I mean, I think they're having less and less impact. I think the further away we get from the inauguration. And so, I think then we've talked about this guy in Fast Money. I was on MSNBC last night, and, you can run around with your hair on fire about all these suggestions, or you can think, what is the most likely outcome, right? And so, like, Trump does not want to shake the apple cart too badly. He views, a report card. I feel like we've been talking about this, in 8 years. Is the stock market. It's really important. So, I just think at the end of the day, they're going to get a bunch of these executive orders out. They're going to own whoever they meant to own over the last 6 years. But at the end of the day, they don't want the economy to fall apart. They don't want markets to fall apart. So, he's got lots of folks who have lots of embedded interest in them doing the pro-growth agenda. Does that make some sense?
100%. And the only difference now is when he took office 8 years ago, it was a much different environment than he's taking office now in terms of valuations, in terms of what the market has done, in terms of other things, not least of which interest rates. So let's pull up the interest rates because, I've been harping on this now for a while. And if you look, that sort of down channel, we're still in it. If we get through sort of 457, 458, we sort of break through it. Now, that's one way to look at it. I think the easier way to look at this is through the lens of the TLT, the 20-year, which you see this downtrend line, which, by the way, this is not Monday morning quarterback. We talked about the potential for it to trade up, make the third point, and fail. And that's basically, at least right now, that's what's happening. Now, a lot can change tomorrow. on the back of CPI. We will see. But if you look at this in the here and now, you say, wow, we're still in this very significant downtrend. Rates should start to trend back higher.
Yeah, so let's talk about the CPI for 1 second before we get to the trade idea and, kind of go deeper into your view on yields. I mean, when you think about, Guy, what the expectations are, I think it's like 2.9% or something like that. Obviously, it's come down a whole heck of a lot, but we know the cumulative nature of that is something that is still making it very hard for consumers to kind of make their way, whether it's food, whether it's gas at the pump and the like. So when all this chatter about trade war, you start thinking to yourself about input costs. We've been talking about this a bunch as we've gone through Q4 earnings season. What is the ability for companies to pass through some of these inflationary pressures? Wages are obviously a big issue. And I think it's the level of uncertainty are the things that could cause consumers to pull back a bit, especially as you see no shortage of headlines about the jobs market. You see the government jobs, right? You see some stuff like, Meta just fired 4,000 people and the like. So there's definitely reasons to be concerned, especially if you see higher inflation readings. So, Guy, what sort of reading do you think to the upside would cause the S&P to move significantly lower? And when I say significant, let's call it 1%.
So anything with a 3 handle is going to scare people without question. I'm not suggesting we're going to get there, but I will tell you this: the components. Now you just have to take my word for this one. The CRB index, which is a different than the GSCI, we've mentioned a number of times.
AGS, right?
At current levels, we're talking about something that's at a 14-year high. The last time we saw these levels was April of 2011. So all things that we don't talk about on the show, that we don't talk about on CNBC, those things have been going up in a meaningful way. Now, crude oil is the headline grabber for all commodities. That's not the real story here. So the inflationary components have been on the move to the upside. So I'm hard-pressed to believe we're going to see things trending the right way. And, again, inflation is a problem. It's going up less fast. I think people have come to realize that. So, I'm sure they'll trot out somebody tomorrow and talk about we're winning the war. They're not winning the war on inflation.
Right. And just to be clear, I said AGS. CRB is the commodity index, which is a lot of crude in there.
But they're AGS in these.
Yeah. Like the way I see it, the more trade stuff, the more trade uncertainty, the more, tariffs that are levied, it's just going to keep that inflation argument going around. And then obviously, if you want to talk about immigration and deportations, that obviously is putting some upward pressure on wages. So let's go back to that 10-year chart that Guy just detailed here. The 10-year yield you see here at 454. Guy, you and I yesterday talked about 4.25. That's that flattening 200-day moving average. Now let's go back to that TLT 20-year Treasury ETF. So there they are. That's the inverse of it. If we get through, Guy, like that yield chart continues to go lower, that would mean the TLT goes higher. It probably brings you up to like 92.70 or something like that to get that,
which is the moving average. Yeah.
Right. So one of the ways that we're thinking about this, if you agree with Guy, if you think that we might have a 3 handle on CPI, if you think there are other reasons that the 10-year yield might go higher, let's look at a play in the TLT. So let's just kind of think about a put spread. Let's think about defined risk. Let's think about March expiration. So something, kind of short dated or so. And we're going to talk about the mechanics of this trade idea. And it's a little bit of a tighter range than we normally would kind of illustrate here. But today, when the ETF was trading around 88.5, I was looking at the March 87.86 put spread for about 30 cents, buying one of the March 87 puts for about 90 cents, selling to open one of the March 86 puts at 60 cents. So it cost me 30 cents. It's a $1 wide, right? So if the ETF is down there at 86 at the short put strike on March expiration, I can make 70 cents. So a little more than 2 to 1. So what am I trying to do here? You say, well, why is it so tight? Well, this is about sizing. Okay, so think about it this way. If you think that there's a very high probability that this trade is break even, right now, if you look at the delta on the 87 put in March, it's about 35. The delta on the 86 put, and let me go to the legend here. This would be the Robinhood legend. And I'm going to show you just how I would construct this trade. So on the left hand, you see all of those different expiries, and they have weeklies. You got to be really careful here on any options chain that you're looking at, that you get the right week for these things. There are dailies, obviously, too. So I'm going to March expiration. I look in here, it's about 88.44. I'm looking down at this 87 put right here. It costs you about 94 cents. And I'm just looking at the 86. I'm going to sell that right there. So I built this ticket here. It's about 31 cents on the offer. You probably get it for 30 cents. Now, how do I figure out the probability of success? Go over to this delta column, okay? That's the amount that if every dollar movement in the TLT, you're basically going to see this option price move 35 cents. Now that's obviously a moving target. And then the 86 is about a 26% probability of, being in the money. And that should move 26 cents or so, that strike for every dollar move. So that's how I'm thinking about probabilities, Guy. That's how I'm thinking about sizing. And I just want to do this one more time. 87, 86. If you were to do this in a one lot, it would cost you $32, right? So if you thought about doing this on a 10 lot, right, you can just kind of figure out what the sizing would be here. How do you think about the trade that I constructed based on your levels?
Well, you're going to know really fast if you're right or wrong. I mean, we're going to 24 hours from now, you will know, which I sort of like, and it's going to be pretty binary. And I think the risk reward sets up really nicely. And I think the probability of success given that risk reward is something you would do every day. And again, we sort of put the fundamentals out there. We put the technicals out there in terms of trading up to that trend line. You can say to me, Guy, I wish you would have told us about this trade like 2.5 days or so ago when we traded up to that. Okay, but we're doing it now. It doesn't mean
you did, by the way.
It doesn't mean though it still can't be right. And again, there are a lot of people out there a lot smarter than I am, which is not a high bar, that think rates are going to go meaningfully higher for a myriad of different reasons. And a lot of it is, some of the political rhetoric that's made its way into the marketplace. I mean, everything you hear is not bullish for yields. In other words, it's not going to make yields go lower. It's going to make yields go higher.
Well, right. And to your point, what did we see this fall when the Fed started cutting? You saw, yields go higher. So they're cutting the Fed funds. You saw the 10-year go higher. That's not something we've seen. I think I sent you a stat the other day, Guy. We have not seen that in 50 years.
Ever.
To that mag. Yeah.
I mean, what we have seen since that rate cut in September, I don't think it's ever happened before. From 3.6 to 4.8, and pretty much in a straight line, back down to 4.4, and here we are at 4.54. So the bond market is not cooperating right now.
No doubt. All right, that's going to be fun tomorrow to see how the market reacts, not just yields, but obviously the stock market. All right, let's do a little options action here,
I
Guy.
remember that show.
You do. That's where I met Amanda Diaz, by the way. She was the producer of that fine program on CNBC. I did that for 10 years, Guy, from 2009 to 2019. All right, so interesting here. I always find this when you have a stock moving one way or the other, and you can't find a headline why it's moving. And then you look around and you try to figure out what's going on. And then you see, options volume is just exploding here. Now, we're not in the camp that unusual activity is indicative of anything in particular. But sometimes it's kind of interesting to kind of drill down and use it as like one input, right? As you're thinking about something. So today in Intel, the options volume is 2 times average daily. And here we are midday. The call volume is 4 times that of puts. Now, you could say, all right, I have no idea. Maybe it's delta hedged. Maybe it's, against something else. Maybe it's a whole host of different things. But when I look at the activity today, it is the February weekly, expires this Friday, 21 strike and 22 strike. And then I go and I look at open interest in those strikes. And there's more volume that's trading than the open interest that came in today. And then I look and see where a lot of these options are trading. What sort of lots? It looks like there's a bunch of retail buying, and it looks like it's short dated, and it looks like it's opening. So I can make a certain assumption based on the price action, Guy, that people are buying calls. When you see that sort of price action in the name where you haven't seen a good headline, I want to say in a year, what does that make you think?
Well, I think, and I'm not suggesting I'm right, but I think if there's a headline, and I'm going to read, and this is from J.D. Vance, the Trump administration will ensure that the most powerful AI systems are built in the United States with American-designed and manufactured chips. So I think participants are taking that and running with it and saying, well, how do we play this here in the United States? And it's with Intel. By the way, not that Intel can be the winner here, but I think if you're short Intel, you got to cover. And if you want to play it for a flyer, I think that's what's happening. I think it's those statements that gave the stock some giddy up.
Yeah, and this is a company that's supposed to get billions of dollars from the CHIPS Act. That was obviously enacted in the last administration. Let's hope the current administration is not saying the sort of things that we heard from Vance and then trying to pull that money back. We know that was something during the transition. I just want to go to 2 more charts on the Intel that really have me thinking about this thing in a different way, Guy. When you look at this 1-year chart, you see that downtrend that's been in place. You see that it's been banging around, just below 20. You have that move today, a bit of a short squeeze. values. You see that 200-day moving average, which has not touched since late last spring. You see it up there at what, 25-ish or something like that. You can see some overhead sort of room to run. One last one. Look at this 10-year chart. And so when you look at this, you had that massive double bottom, right? You had that huge rally into the end of 23. And since then, it's been a disaster. So that level that we just talked about, 25, it's also huge long-term resistance. Now, the last thing I'll say is their CEO's leaving. Remember that? So there's going to be a management change. It's kind of hard to do anything meaningful. But the last thing, remember there was some rumor floated that Qualcomm might be looking at Intel and they might wait until the new administration. So give me your 411 in this.
Well, I mean, the 411 is Intel's a broken company. They got themselves in the wrong businesses. They've basically focused on things that were floundering and slowing down in a meaningful way. That's on them. Good news is they're a bit of a homeland security play, and I think today is proof positive the types of moves you can see. Technically, and Carter would talk about this, if you can get above sort of 22.5, 23, you're going to hear people talking about a bearish to bullish reversal that started in last summer, sort of August of last summer. So I think there's a lot to not about the company, but about the potential for the stock. I mean, a move from sort of 21 to 25 doesn't change anything, but I mean, that's a winning trade.
Yeah, if they had an announcement of a CEO who was a turnaround person, guy or gal, and had maybe some good proximity to the Trump administration, this stock would take off, in my opinion. You'd probably be right up against that 25 level, and maybe you'd be filling in that gap that you see from early 24. One last thing, you mentioned Global Foundries, guy, GFS, that's the way it comes out here. This is obviously a company that makes chips, right? So if you have a design, you go there, you make them. It's not too different than Taiwan Semi. It's actually a competitor of Taiwan Semi. This is one that also got a couple billion. Let's pull up that GFS for a second here from the CHIPS Act. I mean, this is a name that could obviously work also. Let's go. Hold on one second. Look at this thing. It was trading lower today, made a nice little double bottom on big volume. So we'll keep an eye on that one, Guy Adami.
There's, Intel. I don't know if it's the I in your acronym, or I don't know what your acronym is.
My acronym on the Fast Money is Gen AI. You want to know what's in there?
What's the I?
The Intel.
There you go.
And the G?
Global Foundries.
Right. And the E was Electronic Arts.
Come out. It's in the game.
It's in the game. And N is NXPI.
Look at you.
And the A is AMD. So what did I do there? I picked what I thought were all laggards in the Gen AI trade. Now, EA, you may say, why is that in the game? Or why is that in the acronym?
You needed an E.
Yeah, but I was going to choose between that and Expedia. And the reason why is these are companies that will be using this technology, right? And EA is going to be a huge beneficiary, the way the games are created and the quickness in which they can do it and some of the graphics and the whole host. Ironically, before NVIDIA started selling these chips into data centers to trade large language models, one of the biggest end markets was gaming, Guy.
Gen AI.
There you go.
It's clever.
All right, let's do this thing because this is something that's near and dear. I was going to say in my heart, but it's not in my heart. Okay.
Now, you obviously,
let's talk about
this is something that really gets you going.
Well, let's talk about the Tesla. And one of the reasons why this story is fascinating to me, because rarely does it trade on fundamentals. We can agree on that, correct?
Yeah.
So let's just look at, Amanda just put together a slide of all the headlines about the name right here. So you see that European sales, we talked about this last month, sales in Germany were down 60%. Sales in France were down 60%. Sales in I think in California, one of their biggest end markets, were down 11%. They're in a massive price war. Now, you could say this is Elon Musk possibly being, distracted by whether it's Doge or whether it's OpenAI and some of the stuff that he's doing here. I think it has something more to do with BYD. This is a Chinese EV maker. Warren Buffett, by the way, is the largest shareholder, second largest shareholder in BYD. They just announced a $10,000 EV, Guy, with just the same range as a Tesla, with something they call God's Eye. God's Eye. That is their self-driving technology that they are basically giving away for free. Yeah. Elon Musk thinks that they're going to fix their margin problem that they have, Guy, by selling $10,000 supervised full self-driving packages. And that's going to be the thing that they get the leverage and get the margins back. But if you have this sort of competition, I just don't know how that can happen.
Fair. I like what you're saying. Let me say this.
Yep.
God's Eye, that's what they're calling it.
Yeah.
the captain of the Titanic, prior to that ship being launched, was asked the question about that ship, the Titanic, like the integrity of it. And he said, and I quote, "Not even God can sink the Titanic."
Yeah. I mean, the fact that it's sunk on its maiden
You want to
board,
just take a look at me right now, because not even God can sink the Titanic. And what happened?
it sunk.
Yeah.
Like almost
So
immediately.
my point is, like, you shouldn't start like God's eye suggests that there's somebody watching over you whilst driving in this self-driving car.
Yes.
There's no chance that Swizzle's getting in one of those things.
Yeah, but guy, do you remember?
I'm just
you're
telling
a big
you. Like, if I had known that captain said that, I would have gotten on that boat. And I would have told Leonardo DiCaprio, Leo, don't get on the effing boat.
Yeah.
It's not going to go
So
well.
one thing that's interesting, you're a big Vin Diesel fan, right?
Love Vin Diesel.
Okay. Do you remember the Fast and the Furious?
Was he in Titanic?
No.
No.
They had a
Well, you bring
they
him up.
had one of the things that they were trying to get at one point was something called the God's Eye. It was like in the 2017.
Oh, so you think he
version.
ripped it? These
right.
Boyd people ripped it off from?
But let's I think they probably did. All right, let's get back to this Tesla.
You brought up God's
Tesla trouble, right? So you could say he's distracted with Doge. You could say he's distracted with OpenAI. You could say there's a whole host of other things. He's got SpaceX. He's got Starlink. He's got Neuralink. He's got X. He's got XAI. He's got Boring Company. It goes on and on and on. On their last call, he said he goes to where the problems are. This was 2 weeks ago on the Tesla call. They had just issued their worst auto margins that they have had in a very long time. The company is in a perpetual price war right now, and the Chinese are eating them up. Now, you tell me if a big part of this new administration's rollback of ESG is getting rid of Tesla or EV subsidies, they say that it's going to affect them much less than a lot of their competitors. Not so sure about that.
I don't think that's true either.
And then on the tariff front, guy, you think that's going to be something that benefits them? Right. And so Europe has already put big tariffs on Chinese EVs. Well, let me tell you this. Half of Tesla's cars get made in Shanghai. The ones that don't get sold in China are going to Europe. Europe has big tariffs. Europe has also, these other lower cost ones. They also have all the Germans are making them. All the Italians are making them. They got a ton of competition, but it's the Chinese on the low end are really hurting them. And there's demand in China is going to be worse and worse. Let's just go to the chart really quickly here, guy, because this is one you and I talked about it. That that circle right there, that is the election. You saw the gap and it kept on going. Consolidated, kept on going. No fundamental move whatsoever. Since then, we've had deliveries, we've had earnings, and this stock is in a free fall right now. It's touching its 100-day moving average. But guy, you see where that 200-day moving average is? Talk to me what you're seeing.
Well, look, if you go back, so this is a static chart, but if we were to go to a non-static chart, you draw a horizontal line across those tops, it comes in around 280-ish, which was resistance a number of times until it was not post-election. What I've said and what I believe is 350 was sort of this 50% retracement of that 200 to 500 move, 488, but you understand what I'm saying? And now we're at levels where we should theoretically trade right there. So, and that will coincide with the 200-day moving average. It all lines up. Now, maybe we pause here at the 100-day, big volume day, but we said it, I said it when it came out. I said it to Melissa Lee that night. I said, if you had told me with these margins numbers, given the run the stocks had, I said it's going to be down $50. It wasn't. Now, subsequently, that's what's happened when fundamentals seemingly matter. He always throws the carrot out of robo-taxi and all that stuff. The market gets excited. He's been promising that now for the last 3.5 years, if not longer.
Yeah, and I guess the real issue here is that they've just moved away from a lower end EV to better compete, right, with these Chinese that have greater range and they're just much cheaper. And so if it's all about adding value through robots and robo-taxis, and you and I talked about it a few weeks ago when they gave their call, take the over here, people. This thing gained 100% of its value from November 6th or so. Now it's given back over 30%. I think it goes back to, listen, it's not a great press, guy. There's going to be a day like today where there's going to be a headline that comes out. It's going to reverse. It's going to close on big volume, and you're going to get your face ripped off of your short. I am not short. All I'm trying to do is saying that if you buy stocks on momentum, the momentum's broken here. If you buy stocks based on fundamentals, the fundamentals are horrible here, and it makes no sense to own it. But the last thing I'll say, guy, and then we can move on, is that if Elon Musk loses this proximity to the White House, to Trump, then this stock has a real problem, because a large part of that gain, if not, let's say 90% of it, had to do with all of that and his ability to possibly get full self-driving going quicker because removing certain regulation, getting closer to robo-taxi. That's not happening. So again, I think the way that a lot of these tech CEOs, we talked about it on Fast Money last night, think about how they're all competing, right? Zuckerberg, Bezos, he's obviously the chairman, Sundar Pichai, Satya Nadella, Sam Altman, Mark Zuckerberg, Elon Musk. This is not going to end well for about half of them, probably.
Well, I mean, 220 is where it was pre-election. I mean, if you say that he's going to lose proximity and he's wear out his welcome. The other thing we should mention, and we actually talked about it in terms of a trade, if rates go higher, he said himself, when rates were sort of at their zenith the fall of 2023, I guess, was it or 2024, whatever it was, he talked about rates being too high.
Yeah. Well, he was whining about it.
Yeah.
And so, you know, who else is out there is Kathy Wood, who's, you know, a large shareholder. I mean, but both of them are making the argument. So pricing's gone down, rates have stayed high, and their deliveries have gone down and their margins have gone down. That's a bad business model. Let's just be clear. All right. Should we move on a little bit?
No, but you know, people trade this stock. And I'll be the first to tell you, I mean, that move post-election, I didn't see that coming, the magnitude that it did, because it was clearly just on hopium. It had nothing to do, as you said, with fundamentals. The fundamentals, those margins that we saw last quarter were the worst in 5 years.
Yeah.
And they promised us like a year or so ago that you'd seen trough margins. That obviously wasn't the case.
All right. So last night we talked about this a little bit. I can't remember. Oh, we were talking about the GameStop and the MicroStrategy link up. And, you know, my comment was that we're seeing a lot of meme sort of behavior right now, right? If you think about, we were looking at Roku yesterday. We were looking at Carvana. Carvana was down. Let's pull this one up. It was down 99% from its 21 highs. And you and I were talking about this is like, we haven't seen that sort of sell-off in a stock since the dot-com bubble, right? That sort of thing for a stock that had a lot of positive sentiment from a retail. And so let's pull that out to 5 years. And then if you look at how much the stock has rallied, you could have gotten this thing. It was just an option. It was dead to rights here. Look at that sort of. So when you see that come back that way, look at an Affirm. Maybe they want to pull that up. That was like a COVID darling, that sort of thing. And looking at the same range and look at how that's come back. Look at a Roku and stuff like that. You know, this is not bullish. Do you think that's bullish?
I don't personally know. I mean, if you've owned the stock, you know, good on you, as they say, but there's nothing bullish about this behavior. And what we didn't mention, you know, throw in these meme coins that have been sort of taken fancy since the election. I mean, that's foul. That's farce as well. I'll say this, you know, Bitcoin, I don't want to make a big deal of it at 95,000, but, you know, it's made a few attempts now to get back through 100, has not been working out. I'll say for the 100th time, my concern now with Strategy now owning 480 or so thousand Bitcoin, the average price is 65,000. They will continue to buy, which is fine if the price keeps going up. But as they continue to buy, their average price is going to go higher. If while doing so, the price of Bitcoin starts to go lower and they meet at the middle of that gap, see that gap right there? You can do the cursor. That is going to be a problem. I don't know what it's going to trigger. Down.
Yeah.
Down.
The breakout level.
Yeah,
right
there.
Gap. What is she? Who's doing that?
I don't know. But something bad is going to. So that's 78,000. And it all lines up. It lines up with the moving average. So just be aware that if, in fact, the average price for Strategy becomes where the Bitcoin is trading at, that's going to trigger a lot of weird shit that could manifest itself in the broader market, believe it or not.
I guess one of the main themes, Guy, about a lot of things that we just discussed over the last 25 minutes or so is that there was a lot of pull forward. There was a lot of excitement about this pro-growth agenda and what Trump and his administration could mean for the economy, for global trade, you know, whatever it is, reshoring and manufacturing and all that sort of stuff. But now the rubber hits the road. Like, some things have to happen here for these trades to kind of stay intact. So let's just say, for instance, that Scott Bessent, the Treasury Secretary, comes out and says, by no means are we going to create a fund that holds Bitcoin on the Treasury's balance sheet. Well, you tell me where Bitcoin's going to go. I think it goes down 10,000 points in a straight line. You know what I mean? You tell me if they impose huge tariffs on Chinese EVs and there's a knockoff. You know, you tell me what happens to iPhone prices if we start slapping huge tariffs on anything, you know, coming out of China. You tell me what like gas at the pump is if we put 25% tariffs on, you know, the on the Canadians or whatever. There's just a lot of things that seem particularly uncertain. Market has not priced in the risk.
Not at 16 VIX it hasn't. And we've talked about that for a while. And before we get out of here, that's a 16 VIX with obviously individual stocks moving 10, 15% on a daily basis, both up and down. So, it's been muted in a broader market. I get it. But, this pattern that we've seen now over the last couple of weeks of, again, lower highs and lower lows, that is still intact. So just be aware, tomorrow's going to be a busy day.
Yeah, last thing before we get out of here, LYFT after the close reporting earnings, about a 16% implied move in either direction. That's a tough one to play. Just think if you had a view one way or the other and you wanted to define your risk into the print, you would have to risk 8% of the stock price. The average 4-quarter move has been about 20.5. You think of that gap guy that it had after last quarter, and the people that are buying up there maybe was shorts. I just don't kind of see it. I know that this company is trying to lay the groundwork for the next iteration of ride hailing, and it's going to be robo taxi. But we just spent a lot of time talking about taking the over here. Waymo has a good lead. We know that Tesla is very focused on it. At some point, LYFT will probably have to go hard into this. The TechCrunch is reporting yesterday that they have partnered with Mobileye. This is a company I want to take another look at, Guy. Mobileye. We don't have to do it right now, but the timing of this sort of story a day before their earnings, you find that kind of curious here. I'm not playing this one in the print, but if the quarter's good and the stock doesn't react that much, maybe there's some metrics that don't look particularly good. This is the sort of thing that you want to start building a position in. It's got a $5.5 billion enterprise value. So they have good cash on their thing. They're making money. And if they could ever figure out what looks like a good roadmap, no pun intended, then this could be a takeout candidate in a half a second.
Could be. I mean, it's interesting how Uber has sort of separated themselves from Lyft. For a long time, it seemed like Lyft was sort of the better company. That changed a couple of years or so ago. Uber's had a great run since the beginning of the year. Pulling back a little today, if Lyft does something negative, I'm curious to see what happens with Uber. My instinct suggests Uber should go up, but who knows? Maybe in sympathy it won't. But Uber to me is still the way to play this entire space.
Yeah, no doubt. I mean, the last thing, it's just a really nascent space for anybody who's trying to value any of these companies. And I think Uber, the move that it's had of late, it kind of tells you that we're probably a ways off from autonomous ride hailing being a big fundamental driver for these companies. And the flip side of that, that's just look at Tesla and look what's going on over the last few months. All right, that was it, Guy. We covered a lot of ground.
We did
here.
A lot of ground. We have Jeff Richards is coming in.
Oh yeah,
that drops tomorrow.
Correct.
On the Risk Reversal
podcast. Jeff is a prolific venture investor. Spent a lot of time as an operator. I want to say 20 years ago. Private company founder in the software space, and then he became a VC. And it's not just on tech that we're going to cover, but he has a lot of good macro views too. We've talked to him a bunch, so that's going to drop on the Risk Reversal pod tomorrow morning.
And then we have Stephanie Link coming in tomorrow.
Yeah.
Thursday
for Friday. And you know who's going to be on with us tomorrow on the market call? EYT. That would be Liz Young Thomas, or Elizabeth Young Thomas from SoFi.
A lot, busy, as they say.
Yeah. Well, listen.
Well, look, Jerome Powell, good for him. Like I admire somebody that, that has a bit of a backbone in today's world, because backbones apparently are hard to come by. Continue to watch the bond market. I think that's going to be a huge tell. We outlined that trade, and we'll see you folks tomorrow.
Yeah, see you. Thanks.